Hi, thanks for joining Homebuying 101. My goal with this is to create like a really actionable overview of the first steps to get started on home buying, whether that's like even what to do before talking to a lender and getting pre-approved, just so you know what that looks like, costs associated with the home buying process, and then a super brief overview of what the home buying steps and process looks like. So I'm going to share my screen and jump into it. Okay. Let me present. All right. So again, this is Home Buying 101, your home buying action plan. I want this to be really intentional and have you be able to walk away with actionable steps after this. So here's what you will walk away with after this 45-minute Zoom, a clear understanding on how to prepare to get pre-approved, upfront costs when buying a home, the home buying timeline and process. That's going to be a broad overview right now, the loan program information, just various loan programs, and then an action plan that you will walk away with as well. So, okay, I'm going to jump here first and then I'll go back. A little bit about me. My name is Bre. I am a realtor. I live in Loveland, but I'm a realtor in northern Colorado. I have been a licensed agent for just over 6 years, and I just started my own brokerage a few months ago. But I really created this, and my intention with this is I was a teacher years ago, and I wanted to buy a house when I was teaching, and I had no idea like how to get started. I didn't know how to find a realtor. I knew I needed a loan because obviously, like, I couldn't afford a house in cash. I had no idea on where to even find a lender, how to get connected with one. And this is just something like I wish I had at that time. I went to an open house and they had me sign in, and then the realtor called me and my partner at the time. They called us, I think, every day for, I don't know, like a good 6 months. And that just did not feel good. It did not make me want to buy a house. And I just wanted information. And so that is at the end of the day, that's the teacher in me. That's always the goal, is just to provide resources, and just be there as a guide. And I'm always happy to help. And I promise I will never harass you because that doesn't feel good, at least not for me. Anyways, uh, the intention with this, I think that you can never start too early. And so why it's helpful to start preparing now. If you are looking to move 3 months, 6 months, a year, even like 2 or 3 years, that's great. The more information you have, I think knowledge is power. And by starting early, it gives you time to save. I always recommend putting your savings in a high yield savings account as well, because it'll just build a little bit quicker than like your typical bank savings account. You'll have time to look into your credit. We'll go over that today, how to figure out what your credit score is, and then to make fixes. And I'll go over some general tips on how to improve credit, and then resources for you individually if you do need some more work with that. You'll learn the home buying process. I knew nothing about it before getting into real estate. I think that's very normal, but I didn't know that at the time. But this just gives you like a little bit of information about it. And you have time to get your home buying team in order now, to answer all of your questions. So that's, finding a realtor who you know and trust, finding a lender who can help you as well. And I have some resources for that as well. And then planning ahead. At the end of the day, I think it just gives you breathing room to start looking online. I think it's great to browse homes. You can figure out what areas you like, what home features you do like, what you don't like. If you have a general budget you want to stick within, you can see what the homes look like in that budget. You can avoid rushing. So I just think there's no harm in starting early and just gathering information, regardless of your moving timeline. And so let's look at rent versus owning. I also will never be someone to say that it's so easy to buy a home. It's so affordable. I should say affordable. I understand home prices are very high in Colorado. There are many deals out there. There are deals to be had. However, yes, it is expensive. So this is just kind of looking at renting versus owning over time. Because home prices are high and interest rates are a little high right now, in the first few years, if you look at this chart, for honestly the first 4 to 6 years, this is just like a general estimate. It will make more sense. This orange line is to rent. It will be more affordable to rent for the first few years. However, if you are looking to stay in a home over time, start a family, whatever. You don't even have to start a family. If you are just looking to stay in your home for a while, over time, it does make sense to purchase a home because your costs go up. So with renting, yes, it's cheaper the first few years, and then you see the orange line keeps going up. Renting costs, can rise as inflation goes up, as your rent increases. With a mortgage, your mortgage payment will likely, when you buy a home, it will likely be more than your current rent. However, your mortgage rate and your monthly what you pay in your monthly mortgage, which includes various things, it over time it will stay pretty stable. It will increase a little bit as homeowners insurance goes up over time. As your property value increases, your property taxes will slowly increase as well. And if you have an HOA, that can fluctuate as well. However, after the 6 year mark, you can see that it does become significantly cheaper on this blue line. It's a lot lower. It's a lot more affordable and cheaper to own. Plus, you are building your own equity over time. And I think the biggest bonus when I was renting, I didn't want to like hang anything on the wall just because I didn't want to have to deal with patching it. I didn't know if I would move or how long I'd be at that, apartment, house, whatever I was renting. And it's just like nice to have your own space and you can do what you want with it. You can paint the walls, you can hang things up. So just having that little freedom and flexibility is I don't know, it's fantastic as well. So here's a brief overview of the home buying timeline. Whenever we meet, and if we meet in person or Zoom for a more in-depth home buying consultation, I will always go over everything multiple times. So if you hear something once, you'll hear it many times from me. This is going to be a lot like drinking from a water hose, which is why I am sending the recording. So you will have that. You can go back and watch certain parts. This is just a big picture overview of the home buying timeline. And when you get closer to it, we can go more in depth as to what every step looks like. So I like to let's start at the end. On average, I find that it takes buyers about 3 to 4 months from the time they get pre-approved to close. That means sign all the papers and take ownership of their new home. So what's included in those 3 to 4 months? The first step is getting pre-approved with a lender. That can take anywhere from 24 hours to a week. Many lenders, they can turn around once they have all of your papers, they can turn that around in a 24-hour period. However, they will ask for documentation. If you are curious about what kind of documents they will ask for, I have a whole list I am happy to send you. So it really just depends on how quickly you are to submit all of your documents and paperwork that they are asking for. So, depending on your timeline, it can be as quick as 24 to 48 hours or a week or 2 weeks, depending on, just getting all of those things in order. Once you are pre-approved, we will sit down and have a buyer consultation to go over what you are looking for, your timeline, your needs, your wants, your budget. And then you get to do the fun part, house hunting, going and seeing various homes, figuring out and refining what you do like, what you don't like. Are there certain areas you really would like to be in, or maybe ones that just aren't right for you? So on average, that takes anywhere from some people in the first weekend. They've been browsing online, they're ready, they have a tight timeline. They go the first week and they find something and they write an offer. That does certainly happen, and there's nothing wrong with that. And, I think they are just sure about what they want. However, for the majority, that's probably not the case. And I would say up to about 3 months, usually within like a month to 2 months, sometimes 3 months, people are ready to write offers on homes. When you write an offer on a home, we will go over that together. We will go over all the different negotiation points. And with that, once you submit an offer, a seller can just accept it, and then you are what we call under contract on the home. They can send back a counter offer, and you can keep negotiating different pieces of it, or they can just say no. So typically, sellers ask for, once you submit an offer to them, they typically ask for 24 hours to review it and get back to you. So that's the one day. If you're negotiating with them, typically within 3 days, you have either come to terms and are under contract or you've gone your separate ways. So that's within 1 to 3 days once you find the home and your offer gets accepted. Then we have what we call our due diligence period. This is when you are under contract on a home and you are doing things like getting an inspection done to make sure everything looks okay and you want to move forward, and we can ask the seller for repairs. getting an appraisal done on your home to make sure it's valued at what you're offering, looking at different HOA documents and reviewing those if it's in an HOA, just different looking at different seller documents that they may be providing to you. The typical period for going under contract is 30 days. If you have a home to sell or if timelines, are just adjusted, that can be 45 days, a little bit longer, but for the most part, an under contract period will be about 30 days, sometimes up to 45 days. And then finally, after that, it's the best day. You are closing on your new home. You'll sign your name about 1,000 times. So work on those hand muscles, and then you will be homeowners. So here's a little bit about mortgages. Again, this is a high level view. Once you talk with the lender, they can give you more specific details. Here are some different loan types. These are the most common ones that you will see. First is a conventional loan. It's great for buyers with good credit, who have a steady financial picture, such as a typical W-9 salary job. And for that, you need a minimum of 3% down. And then another option is an FHA loan. These are often used for people who have variable incomes. Maybe you get paid hourly, and maybe you need a little bit of credit. Your credit is a little lower. However, FHA is still a fantastic option. For those, you need a minimum of 3.5% down. And then if you are a veteran, you can get a VA loan and you don't need any money to put down on a home. And it's for, active duty military veterans and eligible spouses. USDA loan, we typically don't see those often in Colorado. It's pretty hard to find those because you have to have a land. It's subject to the land or the property, I should say. It's in more rural and less developed areas. So it's just hard to come by. But if you do find a home that qualifies for it, you also can put 0% down on that. And by down, I mean your down payment. When you purchase a home, you will have to put a certain percentage down for the loan. You can't just get a loan out for the entire purchase amount. You will need to come with a small percentage to the closing table with that, and we'll talk about that a little more here soon. And so it can be scary to think about having a down payment. So say, let's do easy numbers. For a $500,000 house, a 3% down payment is $15,000. That could be scary to think about. However, Colorado has a great down payment assistance program. It's called CHFA. I mean, that's the acronym for it. And there's two different options. And so this is if the monthly payment works for you at whatever price point you're looking at, however, you want some support with the down payment. This is available for first-time home buyers, and they have two different types. The first type is a grant, and you can get 3% of the loan amount, so you can put 3% down. It does not need to be paid back when you sell your home. However, it does have a higher interest rate. Then there's another type, which is a second mortgage. This you can get up to 4% of the loan amount. It acts as a silent second mortgage, so you don't make payments on it. However, when you sell your home, you do pay it back out of the equity with your home. So there's two things I like to say with this. It's a great program. I think it's fantastic. If you do the second mortgage, I really, really think you need to plan and be in your home for a minimum of 5 years. I'd say 5 to 7 to be safe, 5 to 10, because you have to pay it back. So if you have to pay $15,000, you need to make sure you have enough. For example, if you were going to buy a $500,000 house and you put 3% down, you use that $15,000 and they helped you with that. You have to pay that $15,000 back when you sell your home. And so with that, when you pay it back, you need to make sure you have enough equity to pay that back. And then when you sell your home, there will be other fees such as paying your realtor and things like that. So you just need to make sure you have enough equity there to pay for those costs. And so that's like one caution I give. Just be mindful of how long you plan to stay in the home. However, here's another fantastic story that I just had maybe a month ago or two. I had some buyers use the down payment, the CHFA down payment assistance program on their home, and they also got the down payment. and it paid for their down payment. And then something you can ask sellers for is called a seller credit or a seller concession. And that just means sellers are giving you money. They're giving you cash essentially, but you don't quite get it in your pocket. Instead, there's some costs that you have to bring, such as like closing costs, and those can be like lender fees, paying for the appraisal, things like that. And they will help pay. So a seller with seller credit, you can use that to pay for some of those fees. So I just had buyers use the down payment assistance program, and then they got $10,000 in seller credits. So they came to the closing table with $200, and they just purchased their home with $200, which is amazing. And it's completely doable. It's not unheard of. This isn't like a one-off scenario. It is absolutely doable in this market for seller credits and everything. And I just think it's fantastic. And now they're homeowners and they only paid $200 essentially. So, in the timeline, I said one of the first steps is to get pre-approved with a lender. And there's a difference between a pre-qualification and a pre-approval. And here's the difference. For a pre-qualification, it's a very quick snapshot. It's a brief overview of your financial picture because they do not, you can go online, find a little pre-qualification, I don't know, a little calculator online, and they will not ask you for any documentation. They will not ask you to verify if you say you make this much or your credit score is this much. They will not ask for verification through documentation. So you'll get an overview of what you could qualify for. However, it doesn't hold any weight. It doesn't mean like, oh yes, you're definitely going to get a loan for that amount. It's just like a brief little overview estimate of what you could qualify for based on the numbers that you feed the calculator. With a pre-approval, this is a lender will look at these documents. They have a team called underwriting, and they're the one who processes all of your loan documents. They're checking everything, they're reviewing everything. Their underwriting team will look it over, so it is more in depth. They will ask you for documentation. Just like I said, there's a list of docs they may ask you for. So they will ask you for the documentations, they will review it, and they will do a soft pull on your credit to see. So you're not just saying my credit is this, they'll actually pull it and see what your credit score looks like. And then it does give you the power to make a strong offer. When you start looking at homes, you will need to have a pre-approval letter from a lender because once you find a home that you love, then we will submit an offer and you have to submit your pre-approval with that offer. So it just has you ready to make offers essentially when you find the home that you love. All right. And so let's go into your financial foundation, such as like what goes into your credit score. Things that impact your credit score are payment history. Are you paying your credit cards or whatever? Are you making your payments on time? Your credit usage, we want to see below 10%. If you can do below 3 to 5%, that's even better. Your length of credit history, I know like this is not something you can really control, but the longer the credit history, the better. The types of credit you have, such as credit card debt, is weighed differently from like student loan debt and things like that. And then new credit. When you are in the middle of purchasing a home, once you're pre-approved, once you're house hunting, you want to avoid opening any new lines of credit. So that means avoid getting a new credit card, avoid purchasing a new car and using a loan for that, some of those things. Okay. And so why does your credit matter? Because you can get qualified through better credit, or if your credit needs some improvement, it impacts what loan programs you can qualify for. And so it's such as like, can you get a conventional loan or an FHA loan? And then it also impacts your interest rate. The better the credit you have, the lower the interest rate that you will qualify for. If your credit is a little bit lower, your interest rate may be a little higher, which impacts your monthly payment. The higher the interest rate, the more your payment will be. If you have a lower interest rate, that lowers your monthly payment. We want to shoot for at least a 620 and above. Anything 750. The higher the credit, again, the better rates overall that you get, and the lower the payment your payment will be. So here are some very, very brief guidelines on how to improve your credit. Number one is paying all bills on time. The second one that I mentioned on the last slide, keep your credit balances low. Try to keep it under 10%. And then avoid opening any new accounts, especially when you are going through the pre-approval process. Once you're pre-approved and house hunting or under contract, still do not open any new lines of credit. And also do not close any accounts either, because that you think, oh, I've paid off a credit card, let me close it. You think you're doing the right thing. However, that also will negatively impact your credit score. So let's not close any accounts either. And these are all very general ones. If you think you need some work on yours, let me know. I can give you a list of lenders who are great with credit, and just talking to your lender if you have a preferred one, or talking to a lender and just saying, hey, I want to buy a house in whatever your timeline is, 6 months, a year, 2 years. I need to work on my credit a little bit. What do you suggest? And they will be able to look at your exact situation and give you tips that are specific for you. So if you're thinking, oh, I'll pay off, this full account or anything, if you are close to getting pre-approved, I would just chat with the lender before and just say, what are your tips? And they will give you specific tips, because sometimes also you think you're doing the right thing by paying off a credit card, and that might not be the best move for you either. Sometimes that can lower it just a little bit. So just talking with a lender to get the correct and specific advice for you. But here are those were some general tips that will benefit everyone regardless of your financial situation. Okay. Once you're talking to a lender, you will hear this term called DTI, and that is your debt to income calculation. So how you calculate that is you will add up all your monthly debt, add up any credit cards that you have, credit card payments that you have to make, add up your mortgage, your rent, add up any loans, car loans, student loans, add up everything that you owe every month, groceries not included, just everything that you get sent a bill for. Then divide that by your gross monthly income, then times that by 100. So you want your debt load to be somewhere between 36 to 49% of what you make every month. That's what lenders are shooting for. 35% is the best case scenario. However, lenders will typically approve you with anything from 36 to 49% of a debt load. If you have questions, I'm happy to answer. This gets a little tricky, and lenders will go over this with you also. However, it's just something, the term DTI, you will hear a lot, so I just wanted to briefly explain it. A lender will go more in depth with it, and that's why we want to avoid taking on more debt, such as buying a new car or anything while you are in the pre-approval process, because they are always looking at this DTI ratio for you. Okay, so those were some lending basics. Now let's go into budgeting for your future home. When you get pre-approved, often you will get pre-approved for more than you feel comfortable with the monthly payment. So you'll get what we call like a max pre-approval. They'll say, oh, you are pre-qualified for up to, pre-approved for up to $500,000. However, maybe that monthly payment is way too high and you're like, oh, I do not feel comfortable with that. Here's some tips that I would give to find out a payment that you are comfortable with. So here's what goes into your monthly payment. It's PITI, so that's your principal. That is like the amount of the house, just the amount of the house that you have that you're paying on. Like the purchase price, of course, it's broken up over 30 years. However, that is actually paying down the purchase price of the home. You have your interest you're paying on. Then you have your property taxes and your homeowner's insurance. All of those things go into your monthly payment. If you have an HOA, that also gets added in there. So once you get pre-approved and they say, oh, congrats, you're pre-approved for, let's say, $500,000 or 550. I would then ask your lender, what would a payment look like if you're pre-approved at 550? Say, what does a payment at 550 look like with everything? What does a payment at $500,000 look like? What does the payment at 450 look like? Just keep going until you find a range or payment that looks comfortable for you and your monthly income. And so if you're like, well, I don't even know what a comfortable like budget for me is, here's a strategy, a couple ways to figure it out. Look at your last 3 months of spending. I know this is like not fun, but it will be valuable, it will be useful. Look at your last 3 months of spending and figure out your budget. So look at things such as like, how much did you spend on groceries? Did you take a vacation or, did you go out to eat? Leave those in there because we want to make sure you still can afford and you still are able to go out and do those fun things like, such as, like doing a date night or going on a little trip, going on a day trip, going out to eat. But then add up other things such as, what bills do you have, your groceries, your gas, all of those things, see what you spend in, see what you spent, and then subtract that from your take home pay to see what's left for housing. One thing to note when you're adding everything up, um, do not also include your current rent because that will be gone once you purchase a home. So look at everything aside from your current rent. Leave that number out. And after this, I will send you a whole like PDF that walks you through exactly how to do this. And it has everything set up so you can track and see what you've spent over the last 3 months to see your average. And then you'll take that from your take home pay to see what's left over from housing. And then you can decide how much of that do you feel comfortable spending every month, on your mortgage. So there is your mortgage payment, and then there's the interest and everything that we talked about. However, there are, a couple other things that go into your payment as well. I did say your property taxes. What does that look like? Um, an estimate is 1%. I would say there's two caveats. In general, if you are purchasing a home that is not in a metro district, 1% is usually high. So this is, estimating on the high end, but 1% of the home value. So if you are purchasing a $500,000 home and it is not in a metro district, it'll be under. But if you calculate $5,000 a year divided by 12 for your property taxes, you will be more than covered. If you are purchasing a home in a metro district is typically seen in newer construction homes and communities, and it is where the developer has passed off some of the fees, such as like infrastructure, amenities, things like community amenities, to the homeowners, and so your property taxes will be higher. I would say anywhere from 1.5 to up to 2.5, up to two, sorry. But 1.25 to 1.75, 1.5, 1.75 are on average. Uh, the percentage of your value is where your property taxes will be if you find a house in a metro district. So it will be higher there. Your home insurance, roughly $200 to $300 a month. It depends on, where you live and your coverage. Homes in the foothills and the mountains obviously are higher because they're at flood risk. So that can vary, but I'd say about $300. 200 I think is a little low right now. About $300 a month, you can estimate for your homeowner's insurance. And then maintenance, part of being a homeowner, the great thing about renting is like, yes, if your water heater breaks, you call someone, they come in and fix it. When you're a homeowner, you are paying to maintain your home and things naturally break. So if you plan for 1 to 2% of your home's value, so if you have a $500,000 house and you save five or plan for $5 to $10,000 a year, you will be more than covered. That will kind of give you a nice buffer to really save for bigger projects, such as say like down the line you want to add a concrete patio, you want to I don't know, just different things. You want to redo the bathroom. Most just general maintenance, it will not cost $5 to $10,000 every year, I promise you. This will give you a lot of buffer room to save for other home projects that you want to do. And then finally, HOA fees. It can range in a single family home on average. I see anywhere from $30 a month or less up to like 80, depending on community amenities, is the range you will typically see on a single family home if there is an HOA. With a condo, I really see if you can find one that's in the 300s, that's affordable. For the most part, I do see between $400 and $500 for an HOA, for a condo or townhome. So just plan accordingly with that. Okay. All right. Okay, so here are some general upfront costs that come with purchasing a home. So I mentioned a little bit earlier your down payment. Depending on your loan type, it can be a minimum of 0% or a minimum of 3 to 3.5%. This is the money you contribute upfront towards your loan on the purchase of your home because you can't buy a $500,000 home and get a loan for the full amount. You have to contribute some with a down payment. And of course, it can go up from there. You don't have to, obviously, you don't have to do 3 to 3.5%. Those are just the minimums. You can do however much you feel comfortable and whatever your financial situation allows for. Then earnest money. This is something you will hear. This is essentially a deposit on the home, and it shows the seller that you're serious about buying the home. The title company will hold it, and it does get applied to your down payment. So if you're putting a down payment of $5,000 and you have earnest money, which costs $5,000, and you've already sent that in and they're holding it, you only need to bring $10,000 for your down payment because that other five from the earnest money gets counted towards it. Typically, earnest money is about 1% of the purchase price. So for a $4,000 home, for a $400,000 home, it's around 4,000. For a $600,000 home, it's typically around 6,000. A home inspection. I always recommend getting a home inspection. On average, a general home inspection will be between $500 to $800. I'd say 5 to 6 or 7 is very typical. In Colorado, I always recommend getting a radon test and a sewer scope, and those are about 150, 175 each. So I would say for an inspection, plan anywhere from 8 to about 1,000. If you plan for $1,000, you will have a little money left over. But in general, with those other two tests, between 800 to $1,000 is what that will cost. And then closing costs. I briefly mentioned this earlier. This is where you can get seller concessions, seller credits to help pay for these. But closing costs are typically 2 to 5% of the purchase price. I think 5% is very high. 2 to 3% is what I see on average. And these are just prepaid expenses such as prepaying for taxes, your insurance, and HOA fees if applicable. There are loan costs from your lender that you will have. It pays for the title company to pull documentation and to conduct the closing and your home appraisal. So all of those are just lumped into what we call closing costs. And then another potential cost is paying a buyer's agent. So historically, sellers have always found it, not always, but historically, sellers find it in their best interest to pay for the buyer's agent fee. So historically, sellers will pay for your agent's fee as a buyer because it can be really hard as a buyer to come up with a down payment, to come up with closing costs, to come up with money for a home inspection. And then if you had to pay your agent fee on top of that, as a buyer, that's a lot of money that someone would need to save and spend in order to buy a home. And that would really limit the amount of home, like the home that they could afford and qualify for. So sellers often, because they want to get as many buyers as possible to look at their home, to be able to purchase their home, they will often take that fee of paying their agent, the buyer's agent, and they will pay for it just to make it a little bit more affordable for more buyers to be able to purchase their home. Okay, now this part is looking into your wants versus needs and figuring out that. So I think we really need to go just beyond of like, how many bedrooms do you want? How many bathrooms? And maybe like, what city do you want? Your home is where you spend most of your time, especially if you're working from home. Even if you're not though, working from home, yes, you want to think about, how your home flows. If you have to commute, you want to think about exactly how far that commute is. We really want to think about when you start thinking about home, thinking about like what your everyday looks like. And so that's like, where do you spend the most of your time? Do you want to be near parks for your kids? Do you want to have easy access to trails for you to go hiking? Do you want to be near trails for your dog? Do you want to be walkable to a downtown area? Do you want to be far away with land? You don't want to be near anyone. Think about where you spend most of your time and your commute times. How far are you willing to drive to the grocery store, to work? I live very close to a Home Depot, and honestly, it's very convenient for house projects. I don't think I would necessarily like choose my house based on that, but it's something like to think about at least. And then think about like with this, your five daily priorities. Do you want somewhere, yes, that is walkable, where you can walk around the neighborhood, where you can walk to a park, where you can run or walk on trails? Do you want to walk downtown? Um, do you want to spend a lot of time? Do you spend just a lot of time at home and you want somewhere really cozy? Do you host? Do you host holidays or do you want to host your friends? So you want a big kitchen or dining room or a backyard to host friends in. Think about all of those because those will all influence the location. And by that, I mean like it's even like what neighborhoods do you like? And would you love to be in? What type of home you want, the layout, and how you want that to flow. And so with that, I think all of those need to just be thoughts and things you think about beyond just how many bedrooms and the price. So then also just think about what matters most to you. Is it location? Is it the space? Or is it the finishes? It can be hard to get all three. So I think sometimes there needs to be a trade-off. Are you willing to have the best location, but maybe you need to put some sweat equity in your home? Or are you willing to have an updated home and maybe it's not right in the downtown area. So just think about just other, things to think about as you are considering what you want your next home to be and to look like. And okay, so this is going on. So I always think it's helpful to make a dream list and a deal breaker list. Write down 5 to 7 non-negotiables, things that you really need or want in your home. And I say this with love, but if you have this long list of like 15 things and you say, I need all of this, if everything is a need, it's not a need. And I promise no matter what your budget is, I've never seen, $1 million buyers, they still are sacrificing on something. There's no home that is going to be a perfect 10 out of 10. We want something that is like an 8 out of 10, but it has all your non-negotiables that you can live with. After you have your non-negotiables, 5 to 7, then draft what would be nice to have. What are great features that you would love in a home? Is it a patio for entertaining? Is it a gas stove? Those sort of things. Is it a south-facing driveway where the snow melts really quickly? And then write for the nice to haves why you would like each item, even for like your non-negotiables. I think it's helpful. Uh, and then circle 2 deal breakers you won't budge on, and then circle 2 dream items you would love but could also live without. And and one thing to say before I move on to that, again, and I will email you a PDF and it will walk you through like this lifestyle mapping and writing down your dream list and deal breakers. It will walk you through all of that. So that will follow this recording and presentation too. Okay, I've touched on some of these. Here are some common mistakes to avoid when you are working through the pre-approval process or once you are pre-approved. The first one is changing jobs or becoming self-employed because that will impact your ability to qualify for a loan. I had someone who she just changed her job was like, how she I don't know the correct terms, but she went from being like a W-2 employee to just restructuring and then going out on her own. And it affected her from being able to qualify. So she had to wait a full year to purchase a home, just because she kind of changed how she was qualifying or being subjected to like being just how she was sorry, I'm like drawing a blank on the wording for this. She just changed how her taxes looked essentially at the end of the day, and was no longer under her umbrella company, even though she didn't change companies. She just changed essentially how she filed taxes and she wasn't able to qualify. Also avoid making large purchases. I know like you are under contract on a house and you're so excited to buy new furniture, patio furniture, a new bed set, a new living room couch. You just have to wait. Wait until you close on the home and then go crazy. But Avoid making those large purchases because your lender will be looking at, they'll ask for bank statements a few times once you're under contract, just to make sure nothing is changing and no large sums of money are just, disappearing or being gone. Avoid using your credit cards excessively, and of course, avoid missing payments. I heard a story once of someone got a, I don't know if it was like a new address or a new card or something happened where they accidentally missed a payment just because they never got the statement for whatever reason, and then they couldn't qualify on their home. So just make sure if for some reason you are getting a new card or if your address changes in this period, make sure you do not miss a payment on your home. Avoid, obviously, I think this goes without saying, avoid spending money that is set aside for closing. And then you don't want to omit any debts or liabilities on your loan application. So that means don't hide like, any debts that you have. Your lender will ask for all of your bank accounts. They will ask for everything and they will find everything. So just say it up front. Just any debts you have, anything like that, put it all on the application right away. I think I touched on this one, but avoid applying for new credit cards. And then one thing, yes, so say you have a family member contributing some gift funds to you. So many buyers have this, that's fantastic. Make sure you tell your lender, and they will tell you the best way they will tell you how to appropriately get those large sums in your account. We just don't want a large lump sum to go into your account and have it be unaccounted for or undocumented or unexpected. So if you are getting a gift fund, that's great. Just make sure you tell your lender that, whatever family member, whoever is giving you money to help with the down payment or the purchase of your house. We want to avoid changing bank accounts as well, just because they will re-ask for everything again. So just stick with your bank until you're done. Avoid co-signing on a loan or becoming an authorized user on a loan. This wasn't during pre-approval, but I had a buyer and they were a co-signer for one of their parents' homes. And so they co-signed, and their parents, this was before they even went to get approved. Their parents missed a loan payment. And so because they were a co-signer, it affected this buyer. So this buyer had to wait a full year because they missed their payment 1 year prior. So they had to wait 2 full years from that missed payment in order to qualify, because it affected the buyer, even though it wasn't his loan and he's not making the payments. Because he was a co-signer, it did affect his qualification. And then avoid any missed or late bill payments similar to credit card payments as well. So I will email you a PDF that will walk you through everything. If you want to take this week by week, here's like a 6-week action plan. Of course, you can do this as quick as you want or space it out. This was just something I kind of threw together at the beginning of the year. I did like getting ready for 2026 home buying plan, and I did this 6 weeks prior. So this can be anytime. However, I will email you this PDF that will walk you through these 6 steps essentially to getting ready to get pre-approved for your home. And it will help you calculate how much you need to save, figure out what your comfort monthly payment is, help you write down your wants and needs. It will have resources on where to check your credit for free so you can see what your credit score is currently and see if you need to take further action steps or if you're good to go there. It will walk you through exactly how to calculate your debt to income ratio, that DTI that I was talking about. And then scheduling a consultation with the lender is the next step that I would say to take when you're ready to start the home buying process, to see what you are qualified and approved to purchase as far as a mortgage goes. I hope this was helpful for you. If you have any questions, I am always available. You can call me, you can follow me on Instagram, let me see, or email me. I think I have my email. Yep. Right here, it's Bre at thecarpentercollective.com. Like I said, I would love to help you with your home buying purchase. And at the same time, I will never, I don't know, I won't call you or email you or whatever, anything for every day for 6 months. I'm always here as a resource. I hope this was helpful for you. And if you have any questions, feel free to reach out anytime. Thanks for coming, and I hope it was valuable today. And I will send this recording out here shortly along with the PDF. So you just have everything you need to get started for next steps when you're ready. Thanks.